All right, hey everyone. Welcome to another episode of Pitch Deck Insights brought to you by Visor. I'm your host, Litan Yahav. And with me are the mega investors, Hans Box and Mike Arndorfer. All of us have more than 120 LP investments. So each episode, we walk you through a pitch deck submitted by GPs who gave us their consent to publicly review it. And this time, we're going to do something a bit differently because our sole objective is to help you become better passive investors and choose the best deals to invest in. And so for this episode, we decided to dive into a different fundamental aspect of investing, and that's sort of the terminology around it, specifically the capital stack that goes into these investment offerings. So, Mike, you want to give us a high level overview, like what that even means? What's a capital stack?
Yeah, you need to go into the investment knowing where your money stacks up with everything else. So there's investments where I've made where we're raising all of the money as equity people, and that's all that there is. So there's 100% equity there. There's no debt, that sort of thing. But a lot of times there's going to be debt involved. Sometimes there's two levels of debt where you've got senior debt, and then you'll have even a mezzanine layer of debt. Or sometimes you'll see these things where they have like A shares, B shares, where A shares are preferred equity, and you can choose, are you going to be preferred equity or common equity? And it's a really important thing for an LP to understand the pros and cons of each level and the risks that you're taking, because a deal that is extremely risky with one setup could be extremely unrisky with another. And that's something that I think is important for people to understand so they know what kind of risks they're taking before they choose to invest or not.
Right. I think the capital stack can just be very complicated or very simple. The more complicated it is, the more important it is to really understand it, right? Hans, like you want to give some more, like dive into that more detail on that before we dive into a slide that you built that's amazing on, laying out all the options.
Sure. I mean, I second everything that Mike said, and the capital stack, and what you said. In fact, the more complicated a capital stack gets in terms of different classes of equity, different classes of debt, et cetera, make vetting the deal harder. And typically, not all the time, but I tend to not want to be in deals that have a very complicated capital stack unless there's a very specific reason for it. So as a passive investor, you want to really pay attention to how simple the stack is or how complicated it is, and understand, are they doing this because they want to, because the deal needs it, and this a requirement of the deal. Maybe sometimes lenders require different classes, or are they doing it as a way of financial engineering in order to increase your returns? But while they're doing that, they may actually be adding risk to you. So there are 1,000 ways to have a capital stack, but what you as an investor have to do is you have to be able to discern your risk profile and where your investment, what share class you are, you can is typically how it's the term, where you land in that stack, and what amount of risk that particular share carries with it.
I also think it's important to emphasize that there's the initial capital stack, and that capital stack might change throughout the holding of the asset, right? Within the fund, if things go sideways, if they require more capital, and then they start to allocate new types of shares, right? New pref equity maybe. And so it might even be different in the initial deck that you review to invest in a deal. Whereas a few years into the deal, they might update that capital stack because they need more money or because things start to change, right?
That's right. I mean, you're seeing that a lot right now where some deals are having to have capital calls or have rescue equity come in. And in those situations, the capital stack itself is actually changing from when the investors initially invested. And they may be getting diluted or pushed down or added risk to them. So as an investor, you need to always pay attention to where you land, whether that's in the beginning or like what you said, if there's a capital call or refinance.
And I think one of the things to remember too is that the people that are below you are going to get paid first, not only all of their money back, but all of the interest that they're owed. They're going to be 100% before the people up at the next level up get anything. And so if you're in a deal that started out with secured loan and then common equity, and that was it, and then now you have rescue preferred equity coming in and you're paying them, say, 15%, they will get back all of their money plus their 15% interest before you get a penny. And so it's one of those that you have to just be aware of that as you go, because I think sometimes people gloss over it. Or in something where there's like A shares, B shares, you want to know how much there is. It's like if the A shares are 5% of the deal and it's a 65% LTV primary, it's like, okay, then that means common equity is still at 30% and it's probably fine. But if it's a 70%, you know, first loan, and then you've got 20%, preferred equity, well, then that means that you coming in as common equity in the B shares is only, that's only 10%. And so there's a lot of people that are going to get paid in full before you get anything.
Right. And you mentioned a lot of terms there. I think that, the high level, there's always going to be the basically three, and Hans, correct me if I'm wrong here, three main types of holdings, right? The people that might have pure equity and there are different levels of that equity. The people that might have pure debt and different levels of that debt. And there might be people that have equity that can be debt that can be converted to equity, right? And
Right.
so, that just the combination of all those three with different stacks inside of each of them just creates a totally complex potential cap table. In my world of tech startups, it's a cap table and not a capital stack. But within the cap table, there's also different levels of holdings. But I think it's the same idea. How about we dive into it, Hans? Let's see like the slides of you have that sort of lays that cap stack in more detail. Unless there's anything else you guys want to share before we dive into that.
No, I think we dive in here real quick. So this is basically a pictorial representation of a capital stack. There can be actually more types of capital than just the four that are shown here, but these are the four main types, and even some of these types may have subtypes. But generally, the idea here is that as you go from the top down, risk goes down and returns go down. And as you go from the bottom up, risk goes up, but returns go up. So risk return profile. Typically, a normal real estate deal will have senior debt here at the bottom, the primary mortgage, and then we'll have common equity. Basically, the rest of the money in the deal will just be investor equity in addition to the debt. Obviously, the debt, might make 5 or 6% interest rate, and they get paid first before the equity gets paid. And then the equity makes all of the upside, all the returns. So the higher risk, they make a higher return. And then as you add layers, you add different levels of risk. Many times you see nowadays guys adding preferred equity into the capital stack. And what this basically means is it is equity, but it sits in order of importance above or more important than common equity, meaning it gets paid first, but it has a capped return. It might make only 12% or 15%. It's not going to, if the deal makes a 30% IRR, preferred equity is only going to make what their contractual agreed upon amount is and no more. And that's why people use preferred equity, because it's a way to, because some investors would prefer to have a lower risk and a lower return, and some investors would prefer to have a higher risk and a higher return. So there's nothing wrong with preferred equity. It's actually a way to increase the returns to the common equity. But by adding preferred equity, you are also increasing the risk to the common equity, because effectively what you're doing is you're saying the common equity now is a smaller tranche of the total capital, meaning they're going to get paid, they're getting paid even further down the line. But again, nothing wrong with preferred equity as long as it's used conservatively and in the right situations and in the right manner, and as long as it's obviously disclosed to those with common equity. I could read through all this detail. Mike, I'll let you add some comments here that I may have missed about preferred and common equity.
Well, I would say disclosure is part of it. I recently was talking with a GP who was raising, and he had his deck out. He had about half of his raise done, and he was having trouble with the raise. And then he was looking for mezzanine debt. And that's where I'm like, that's not okay. Like you need your GP to understand ahead of time what that is. Because I at least would not move forward if I had been those people that had already, committed to this deal. And then you come in and you put in mezzanine debt because now you're creating an entirely different profile of risk for the common equity. Like maybe there's more upside, but in this situation, it was a decent preferred return. It was a 10% preferred return and then a 50-50 split. So really it was going to be a lot better for the GP than probably as far as a risk reward profile than for the LPs. And it would have been something that I wanted to bail on. But making sure people have a plan and you understand it is, I think, the biggest thing. because I normally come into common equity positions, but I'm in one fund that is a development deal where they are coming in as preferred equity, and it's something where we're getting 15 to 18%, and I know that that's all I'm going to get with that fund, but I also am taking a lot less risk. So the common equity may make 400%, or they may lose all their money, and I'm going to be in that preferred equity spot that it's a lot safer. And I think just making sure that where you're at fits what you're wanting to achieve with this investment.
Exactly. And, a good example of this is a lot of people just look at senior debt and common equity and go, okay, the debt is at 70%, the equity's 30%. That's not a high level of leverage. It's not really low, but it's not terribly high for a normal real estate deal. But what happens is if you add preferred equity, they add 10%. Suddenly now the senior debt is 70%, preferred equity is the next 10, so now you're at 80. So the common equity now is sitting at that last 20%. So effectively, the common equity basically, it's for them, it's like you got an 80% loan versus a 70% loan because the preferred equity, in terms of its treatment for common equity purposes, is treated like a second lien or mezz debt. Mezz debt and preferred equity are very similar. They're not usually used, not usually, at the same time. It's usually either use mezz debt or preferred equity. I see preferred equity personally more because most senior lenders don't want a second lien on the property, but it definitely does happen. So, as a common equity shareholder, and what most people listening to this podcast will be investing in, you've got to look at where the amount of debt is. And when I say debt, I mean the senior debt plus any preferred equity or mezzanine debt on top of it. Where is that last dollar in? Does it end at 75% of the value of the property? 80, 90%? The higher that last dollar of debt goes, the more risk there is to your dollars coming in as common equity.
I have a question around that because I mean it's really clear the difference between the equity and the debt within and also between the common equity and the pref equity. But when we look at DEX and we see that there are three sets of shares, which are presented as three sets of common equity shares, A, B, C, whatever it is, and each of those sets of shares has different return or different preferred returns. They're all still common equity, or would you define different levels of preferred equity?
No, they would all still be common equity, but it depends on whether or not one of them is paid before the other. Then it would become pref equity. But if they're all being paid pari, and you'll see this term pari passu, I don't know where it came from, what it may be Greek. It's a word meaning equal. So if these other classes you're speaking of are all paid at the same time, Litan. In other words, that if I get a six pref, but because you invested 500,000 and I only invest 100,000, you get an eight pref. That is that, and we're paid at the same time. Then we're both common equity. Now you're getting a higher return, so you're getting more of your money back sooner. So technically, you're being more de-risked than I am. But in terms of like whether your capital is paid back first, typically when I see the scenarios that you're talking about, they are equal in terms of they're both common equity. Just one gets paid more of the upside than the other. That's my understanding, usually. But again, it's a deal by deal thing. You've got to dive into these
Right,
details.
exactly.
But
And,
that
and
was
I,
a great point to bring that up.
because I think it's important because we see this really nice separation between these four levels, but within each of these levels, there's also it breaks down and it becomes more convoluted as well because even the pref equity there can be multiple levels of pref equity within a deal, right? It doesn't have to be
Yeah,
one
and
level.
that's a red flag to be honest. If I see multiple levels of pref equity in a deal.
Well, do you
Yeah.
see that? I mean, from the get-go, you don't see that many. Maybe I'm wrong. You don't see that many decks, like just initial raising for a really straightforward deal where they have senior debt and common equity. You don't really see that many that have from the get-go mezzanine and preferred, right?
I see a fair amount of preferred equity. I don't see much mezzanine debt in the real estate deals I look at. I do see a fair amount of preferred equity. You'll see those, there's a lot of institutional firms out there that want to come in with a $5 million check and make their 14%. And then they fill that gap and it actually helps with the fundraising. I do see it. You're right, though. Mostly you just see, especially when you're looking at newer syndicators and smaller deals, you're seeing senior debt, then you're seeing common equity. But within that common equity, one guy might, one share class might be getting paid a seven pref, the next one is an eight pref based on how much they invest. That is not pref equity unless one has preference over the other in terms of getting paid what they're promised they'd get paid and getting their capital back. Then it would become pref equity. So you've got to really dive into the legal docs.
Have you seen preferred equity that has more rights, not just from a distribution standpoint?
Oh yeah. Oh yeah.
Mm.
In fact, some of these
Right, to
pref
take over the project and
will
things.
take over projects. Yeah, they want to have a right of first refusal to, if a debt payment is missed or something like that, that they will take over the project. So sometimes they can force a sale by a certain year, things like that. So you have to really dive into the details. If you see pref equity, nothing wrong with it, because usually what happens if the deal goes well and does what they're projecting it to do, what happens is when you use pref equity, it actually increases the returns for the common equity. But you got to dive into the details and look at the downside and see what rights does this pref equity have? Can they take over the deal? Can they dilute us? And things like that. You've got to really dive
And
in.
what's their history? Do they
Yeah,
have a history of taking over deals and that sort of thing? Because some have a reputation for that. The other thing I was going to mention that I think sometimes people miss, Hans, in your example where you have 70%, say a senior debt at 6%, and then you bring in another 10% of preferred equity that's at 12 or 14, that 10%, they're going to get all of their interest back. So if this is a 5-year hold, if it's a 14% deal, it's not only the 10% that they've put in, but it's their 7% of the deal of interest that they're going to get, because 5 years times the 14% times 0.1, so they're going to get all of that money back before you get paid, which if everything goes well and as the person's planning, it's fine. And like you said, you're going to make more money on common equity because they're not participating in the upside. It's really just on the downside. If things start to go bad, you know that they're going to get paid out completely before you get any of your money back.
that's right. Yeah, great point, Mike. Great point.
I think it was super interesting and important to dive into the cap stack because again we've gone through decks. We haven't really dove into this aspect of it. Is there anything else, Hans, that you'd want to add just to make sure sort of that investors know what they're doing in terms of the cap stack?
Only that, the more different share classes you see and the different types of capital being used, the more your antenna should go up and you should really start asking questions. And this goes for any deal and anything that you don't understand, but really the more complicated it gets, usually means not usually, but it can mean there's financial engineering going on. And they're trying to make a deal work by having different share classes, or they can't raise the money. So I would just caution everyone that if you see a bunch of different share classes, start asking questions, make sure you understand that. And if you don't understand it, have an attorney review the legal docs so you truly understand where your money lies in this whole stack. Because as there's more share classes, and if you're at the common equity, your risk is going up, up, up. The more share classes that are owned.
The other thing I'd mention that isn't on your list there, Hans, that I'm seeing more of now is when the seller is doing a second carryback of some sort. So there's some sort of secondary financing
That's
by
almost
the
like mezz
seller.
debt, right?
Yeah, and exactly. So it's mezzanine debt or something like that. But you need to understand the rules with it and how that interacts, because there's times, and also to make sure that senior debt knows about it and is fine with it, because sometimes they are, sometimes they're not. But
Correct.
that's another thing that has a lot of variability to it, and you just want to make sure that you understand what's going on, and that you're comfortable with it.
Yep.
For example, there's a deal that I'm in where the land is being purchased for, it's about $1 billion development project. The land is being purchased for 200 million. We raised 100 million, about 103 million, 3 million of soft costs, 100 million to pay for half of the land, and then the owner is carrying the other 100 million. Well, the deal is, and then we need to, there's certain things where that could be very dangerous because we're going to have to do construction loans and the interest is coming up. So like I needed to get comfortable with the fact that if the project is delayed, they can't make us start paying payments on it. And when we go to get a construction loan, it's important that debt is going to be subordinate to the construction loan and that they're agreeing to that up front. And just lots of little nuances like that can make or break a deal, of how dangerous it is. And you want to be understanding it and dig into that so you understand exactly what's happening, how they get paid back, when they get paid back. Like in this case, it's a situation where every condo that gets sold, 750,000 goes to pay off that amount. So it's sort of like we know the first 130 to 160 condos, depending on how long it takes, like we're not going to see any common equity payments because it's basically the profits are going to be going back to be paying that off. Then that's when you start getting it. But just that understanding stuff, because things can get really complicated.
We're talking about real estate, right? But at the end of the day, almost every private equity fund has a capital stack within it that it's important to pay attention to. It doesn't really matter what the underlying asset is or how big the fund is. And I'd also assume the larger the fund, the higher potential for a convoluted cap stack, right? Like the Blackstone funds probably have like a crazy capital stack as opposed to like a small syndicator probably has a more simple one, right? And so the red flags, I agree, but like sometimes these bigger funds, it's like built into their structure. They have this capital stack, right? So I don't know if it's necessarily a red flag. It's something you just need to pay attention to.
Well, and even things like a debt fund. So, example, you could invest in a debt fund that is going to be going out and making loans, and you need to know are the loans that they're making senior debt or are they mezzanine debt? Because you have a lot more risk if they're mezzanine debt. You need to know is it only the money that they're raising from you and the other investors that's being loaned, or are they going to some sort of a bank or a warehouse line of credit and adding in their money into it too, and just being aware of all that can change the risk profile very quickly on these things.
I agree. Great point. So you need to know the capital stack within the capital stack.
Yes.
Exactly. Awesome, guys. All right. Well, this has been super interesting. Any last points before we wrap this up?
I would just encourage people to make sure they understand. I think, as an LP, your job is to do all the research ahead of time and make sure that you understand everything, and to reach out to people that know this stuff if you don't, or just make sure you know what you're getting into. Because I sometimes have seen LPs where they didn't do enough due diligence ahead of time, and they didn't really think through the consequences if things don't go well.
Yes. Remember, debt is your biggest partner, and too much debt kills deals. And basically, this defines the debt, and kind of the senior debt and preferred equity is really just debt for the common equity purposes. So always remember that.
This is a great slide, Hans, by the way.
Well, thank you.
All right, everyone. That wraps up another great episode of Pitch Deck Insights. A huge thanks to Mike and Hans for their expert insights today. Stay tuned for our next episode for more investment insights, and don't forget to subscribe. Share your thoughts below and check out Advisor to track and manage all your private investments. Thank you for joining us, and until next time, keep investing wisely.